Well, I'd like to welcome everybody here today on the Evenco Trend Watch webinar, and we'll go ahead and get things started. My name is Tim Craighead. I'm the Senior Equity Strategist at Bloomberg Intelligence and one of our research directors. And it's absolutely my pleasure to be your sort of host and moderator for today's event. I'm joined by three very interesting panelists who have got a wide range of experience and will, I'm sure, have a very interesting discussion over the course of the next half hour, 40 minutes or so. I've got with me, as I said, three, I think, very interesting voices and vantage points. Alessandro Greppi joins us from Zurich Investment. Ismail Palantir is coming from Monaco. And Andre Havas is joining us as well. And what we'll do is touch base on a couple of housekeeping items and then jump into a few key topics that we'll explore. I'll come to those in just a few minutes. But on the housekeeping front, we will have a series of points and discussions, counterpoints over the course of the next half hour, as I said. We'll happily field questions along the way. Please feel free to interject anything you'd like in the chat with the webinar. To mention something about Evenco and BI, just for background information, Evenco has organized now 8 of these Trend Watch webinars on a variety of topics over the course of the last 6 months or so. And they've also do in-person events. If you aren't actually familiar with them, they're quite, I think, timely, topical, exceptional events that bring together asset allocators and fund selectors with a series of funds that are talking about what they are offering from the standpoint of different investment products. There's been a series this year that have ranged from across the Nordic region, Copenhagen, Oslo, Stockholm, Helsinki. Next a week and a half, they shift gears and go to Spain, and over the course of the next several months, there'll be events ranging across major European cities. So do stay tuned with these timely, topical, thoughtful presentations with some very interesting funds to consider. Bloomberg Intelligence, by way of background, we're a full-blown investment research business that is part of the Bloomberg Terminal subscription. I'd be thrilled to chat with anybody offline about what we cover across assets, across regions, top-down strategy to bottom-up company research, and we'll go from there. Without further ado, though, let's hit on the topic at hand. It's interesting to think about the banking scare, and we've used the word scare in the title as opposed to crisis, which we'll come to. But thinking back in early March, I happened to be on a trip to Japan and Hong Kong, seeing our teams there, and the news hit the proverbial fan with SVB. With its problems, and it quickly escalated, obviously, moving on to other U.S. regional banks with concern, to Credit Suisse, an awful lot of cross-asset analysis and events to think about what the ramifications happened right then, at the moment, across the sell side, buy side. Certainly we were involved from a Bloomberg Intelligence perspective. And at those fund forums that I mentioned across the spring, there was a ton of discussion. What are all the lasting implications? And then we got into first quarter earnings and all seemed benign and done. there weren't further deposit problems with U.S. Regional banks. Credit Suisse seemed to be a single event that's being dealt with from a UBS perspective, and it does make us think and wonder and take pause. Is there complacency? Is there more to consider? And I think this is what we want to get into with today's webinar. Now that everything has calmed, what are the lasting lessons that we need to consider? So without further ado, I think what we'll do to begin with is start with just a little bit of an intro with our panelists. Alessandro, do you want to jump in, give a little of your background, and what this topic means to you?
Sure thing. Good afternoon, everyone, and thank you for inviting me to this webinar. My name is Alessandro Greppi, and as Tim was saying, I am a unit-linked portfolio manager at Zurich Insurance in Milan. And my primary responsibilities at Zurich are strategic and tactical asset allocation and fund selection. For me, the topic of today is relevant because I believe that assessing the impact of events such as Silicon Valley Bank's failure is crucial for several reasons. And the first one is that Silicon Valley Bank was a prominent player in the financial industry. It was a niche player, of course, because it was focusing on financial services to startups and venture capital, but it was quite a big regional bank. Furthermore, the failure of a significant financial institution like SVB was one of the first credit events triggered by the Fed rate hikes. And in general, when some cracks appear in the system, it's a signal that we should be close to the end of the hiking cycle. And regarding the SVB story, the vulnerability shown by the bank basically was the result of having a high portion of uninsured deposits and a large proportion of deposits invested in hold-to-maturity securities. And this combination created the perfect storm as soon as depositors became aware of that and asked for having their money back. And this is something that many other regional banks have in common, and also the other failures that we experienced shown. So these are quite compelling reasons for still considering this topic relevant for us.
Oh, good stuff. Thank you. Appreciate it. Ismail, can you give a little intro of where you're coming from?
Yes, of course. And first of all, thank you to Evenco and to all my colleagues that are participating today for the invitation. So I will introduce myself. I currently work as a fund selector and portfolio manager since 2020 in Morabanc, Andorra, which is a little and beautiful country in the mountains between France and Spain, for the people who doesn't know it yet. We work 2 people in our team, so we try to cover all different kind of assets, understanding our capabilities. We are just 2 people, but we do it in traditional and also in alternative markets. We are managing 2 fund of funds. The biggest one is a global equity, and the other one is a thematic one. And we are also in charge of preparing shortlists for our private bankers and for the advisory team, where I used to work prior of switching to the fund selection team. I think that the topic that we are covering it's really interesting because most of us, most of the participants that are attending this conference have had some direct or indirect exposure in our portfolios. So I think it's good to exchange our point of view and what we have learned about this, and to exchange our opinions if we think that it can last at least for the following 12 months, and how can we tackle it.
Oh, very good. And last but not least, Andre, can you give us a little perspective on yourself and Alpha Trail?
Yeah, sure. Thank you very much, Tim. And Thank you for having me on this panel. I have a keen interest in this topic since 1997. Been working for very large institutions and very small hedge funds as well. So any event of this size is always interesting to debate and also to hear other participants in the market's opinions and advice on how to tackle it. But my interest lies basically in the event itself, and also from a standpoint that it's relating to the banking or financial sector. And all of these type of events, they always have a reoccurrence, but they have a variety of trigger points. And I think some of the trigger points that have led to the events which are on the topic today are interesting for a wide variety of reasons. One, the exposure, underlying exposure from one of the banks, SVB, and how they have been exposed to a certain sector in the market, and also the future repercussions that this might have for further financing of the IT sector, but also ultimately what we saw with SVB was something that I experienced already in 2007 when there was a run on the Northern Rock. This was basically a run on SVB where people wanted to have their deposits back. And I think what's always interesting is that ultimately the role and the systemic reason for a bank's existence is ultimately to keep deposits, lend and borrow money, but sometimes things can get out of hand, and that's when we kind of can anticipate these type of exuberant events to take place. So just to add a little shortly to this will ultimately also trigger asset allocation decisions. So there's a before and there's the event, and there's the analysis that you have to make as an allocator, how this can have repercussions going further in your asset allocation, or whether you need to do something about your investment policy. And I think those type of questions are very interesting also from an intellectual perspective, because what was before is something that sometimes is hard to anticipate, but when you have everything on the table, that's when you have to make some sort of a decision going forward for the money on behalf of the clients that you manage.
Oh, fair enough. No, look, I think all of you all made interesting points from the standpoint of why is this event that in some ways seems yesterday's news still relevant today. That said, first question I'll ask is and I think I have to ask it, but we can get your perspectives in a concise way and then move on to maybe more depth of where do we go from here. That question is, though, are we done yet? Was this simply a scare, or is it still a crisis to be concerned about in and of itself as it presented itself in terms of deposit risk, or potentially other implications that we haven't seen yet? There's that old saying about you only see the rocks in the river when the river goes dry. Are there other rocks that have yet to present themselves but will? What are your thoughts? And we can go in any which way. Andre, you were just chatting. If you want to keep the microphone, so to speak.
Sure.
But Ismail and Alessandro, feel free to jump in also.
Okay, thank you very much, Tim. I will continue my rant. So, no, I mean, from a local point of view, and I'm based in Stockholm, we have had implications in the pension systems from the SVB debacle. So we had one of the major pension funds in Sweden who was heavily invested in SVB, both in from a relative point of view, but also from an absolute point of view. So even though their excuse now is that loss will not have any material impact on the future payouts of pensions, still it's a loss. And you can't just make excuses that in relative terms the asset pool is so big that this would be a negligent loss for future pension payouts. So I think that and that is an example of an imminent consequence of what we saw a couple of months ago. The long-standing consequences of this might be a caution towards these type of very niche banks who are exposed to one sector, to one industry, and they take on quite a lot of risk in both assets and instruments that are very, if you like, exposed to one certain industry, and maybe this will be something that can have a negative spillover effect with banks that are pursuing the same kind of a business model but with a much more efficient and sophisticated risk control on their side. So I can see that could be one of the repercussions from the SVB debacle. And if I can make a quick note on Credit Suisse, I mean, Credit Suisse is one of those banks that it has always been very important from a societal and systemic point of view, and we have had numbers of these banks who have been in quote unquote bad banks, but still being in business because of the assets and the client base, and also their role in from a systemic point of view.
Oh, fair enough. But Ismail, Alessandro, if you want to jump in.
Yes, I go. So to answer the question, if we are done yet, of course, I don't own the crystal ball for the future to make forecasts, but I'm honestly thinking that we are not done yet. So we have to take into account that we have been in an era of low interest rates and easy money for all different countries, facing some crisis in between, and we have had an exponential increase in rates to take on inflation. And we have to take into account that after that sharp movement in rates, there is always something that breaks in real economy. Regional US banks have been one of the most sensitive kind of business that are directly affected. So we probably can expect that in the following months, hearing bad news about that kind of businesses. So just to answer a little bit, we could expect more banks failing. So just to clarify, we don't see a contagion effect in big systemic banks in the United States, because they are in a very different situation than the one we saw in 2008. But we have to consider that after hiking rates like that, something can break. Maybe it's a first round or maybe it's a second round effect, but there is always something that affects the economy, the real economy.
No, fair enough. And thank you. And Alessandro?
Yeah, it's always hard to speak last, but I will try to add something to what my colleagues already said. I agree with the fact that now we are dealing with a crisis that is affecting specifically US regional banks. And basically, this is the result of the deregulation that we have experienced during Trump administration that led also to stress test exemptions for those regional banks. So basically, they could avoid interest rate shocks stress test. And this led all the issues that we have seen in the last month. So I will conclude this answer just by quoting JP Morgan CEO, and I agree with him when he says that he believes that the current crisis is not over yet, and there may be some repercussion in the future. Basically, because if the banks are scared, they will just stop to do their job, that is lending. Mm-hmm. And if they stop to lend money, the system breaks. So this is the biggest issue that I see for the future.
No, fair enough. And I have to say, from a Bloomberg Intelligence perspective, there are two things that come to my mind as an equity strategist. One, even if there isn't another failure like this, we still haven't felt the lagging impact of a very, very significant rate rise across in an orchestrated way across a number of developed economies. And it's interesting looking at how financials have been an important part of the rally we've had since last autumn from an equity market perspective. And it's all been riding the wave of rising net interest margins, positive earnings revisions. We saw that again in Q1 in many instances, better capital returns, dividends, buybacks, etc. And what's going on from here, I guess we're a little bit concerned about. Even if we don't see another cataclysmic problem or failure or what have you, we think a lot of the good news is now past us from the standpoint of net interest margins. And what we don't have at this point is a lot of discounting of an eventual pivot and a potential asset quality problem. And you can look at that through various ways in the lens of credit strategy, credit dynamics, what's happened from the standpoint of fallen angels, for example, or credit issues, which are quite low right now, notwithstanding this pretty radical rise in rates. So it's an interesting thing. Specifically, I'm sitting here looking at a chart of the UK market, looking at financials, relative to the overall FTSE 100, and it's clearly been a massive driver since autumn. It's been a major driver over the course of the past month and a half once the dust settled in March, and it does make us wonder how long this lasts. But nonetheless, a couple of you all mentioned regulatory dynamics. Do you think the regulatory response has been adequate? It's interesting, Alessandro, you mentioned the what transpired in the last U.S. administration, that could have helped feed this situation. What about what has transpired afterwards, whether it be from a U.S. vantage point, a European vantage point? Any thoughts on this?
Yeah, I think that it's always hard to make an evaluation of policies because you understand that something is wrong when things have already happened. But anyway, I think that in terms of regulatory response, I believe that the FDIC, so I'm talking about the US regulator, did the only thing possible in that extreme situation. And talking about Silicon Valley Bank. So basically what they could only do was to find a buyer for Silicon Valley Bank, and they found it in First Citizen. So this was the only way to calm down the market. But this makes also banks bigger, and we are always talking about the same thing. Banks are becoming always too big to fail, and this is something that we have already seen during after the great financial crisis. So this is some recurring thing that we talk about. Looking also at what the central bank perspective, if we want to consider it also as a regulator, given that it deals with the liquidity injection in the system, I believe that the Fed did a masterpiece in a sense, because they stepped in with a huge liquidity injection in the market, and this was enough to calm down the market. And they knew that basically the market is addicted to liquidity since the first QE, and they found the only way that they know that could really stop the sell-off and the panic. And what impressed me is that also until that moment, the S&P was trading, for example, in 400 points range. And after that Fed intervention, the market bounced back to the 4,200 area with a massive rotation toward tech mega caps. And this was really impressive. Luckily, we enjoyed this rally because we had an exposure to US quality factor. So we enjoyed it, but of course, it was something a little bit counterintuitive because I was expecting a defensive action from this kind of exposure and not to benefit on the upside, actually. So
no, very good. Any other thoughts, Ismail or Andre, on the regulatory front before we shift to sort of lessons learned and thoughts about what you're doing now?
Yes, I want to say something. I would say that maybe some people don't agree, but the interventions that the regulators made in United States seems like hidden quantitative easing program. By not saying that word, but they put a lot of money just to back all the investments and to transfer and restore peace of mind to investors. And I think that's crucial because we know that our business is all about confidence and to believe that our money is going to get back to our account. So I think that without that reaction from institutions, we probably have recommended our clients to do a step back in all investment related to that sector. But we have had the luck that they did what they have to do, and hopefully we will recover from that.
No, very good. Andre, did you want to jump in on this?
No, I completely agree with my colleagues, and I think, sorry, the US is much more nimble and efficient in those regulatory interventions, and also the effect of those regulatory interventions are very much more relevant than what you sometimes have seen in Europe after the financial crisis. So I think and also what Ismail just said, to restore the confidence in the markets is crucial, because without the confidence, markets, they don't operate efficiently.
No, very good. And we totally concur. Let's take a step back and think, in the wake of all of this, what are you doing or thinking now that's different than what you were thinking or doing back in January, February, before all of this came about? It's a broad question, and you can kind of think about it in terms of what lessons did you take away? What are you doing? Ismail, do you want to jump in on this one first? Yes,
of course. Well, first of all, we have talked about Silicon Valley Bank, and the other example was Credit Suisse. So we need to understand, in my point of view, that even they are included in the same sector, the financial ones, their kind of clients and businesses are really different. So Credit Suisse was in troubles for many years due to the risky investments done in the past in some hedge funds that they failed recently. And on the other side, Silicon Valley Bank main issue was the effect on leverage and also on covered risk of durations in their deposits. Alessandro explained it really well before, so I'm not gonna take a long time trying to explain it again. So the thing that we probably learn is to be even more prudent and to assess more in depth some of the recent issues faced by the failed banks. So just to be just to consider more things that with that high interest rates and with the lack of credit to cover the future debt, it has to be well assessed. No, very good. Andre or Alessandro?
My just very quick response to this would be that from a asset selection and investment point of view, these type of events, they do create some opportunities as well. And it might sound a little bit daft in the sense that often these kind of events, they also imply that there are capital losses. But from a diversified portfolio point of view, and especially if you're focusing on the US, these type of events, they create quite some nice opportunities in, for example, distressed market, distressed credit, and these type of investments that you should from time to time keep in your portfolio as long plays or as short-term tactical plays. But and I can clearly see that if we have repercussions from SVB, and you would see spillover effects from similar regional banks taking the same toll, you would probably have a very interesting distressed credit market and distressed market for securities that could be picked up by savvy investors who could make something good out of it for clients, and ultimately also be a very interesting piece of allocation in a well-diversified portfolio.
No, fair enough. And Alessandro?
Yeah, on my side, I believe that the 2023 banking crisis pushed both investors and fund selectors to a reassessment of their risk appetite. March events pushed portfolio managers to reconsider, I think, their investments in the lowest quality corporate bonds, because everyone was enjoying the carry trade since the beginning of the year, and the exposure also towards more cyclical sectors in favor of defensive growth stocks. And this is what we have done in our portfolios. I also believe that, and this is another thing that we did in our portfolios, this event may also represent the end of the outperformance of the European stocks versus the US equities, given that European stocks are more cyclical, and we are approaching, it seems that we're approaching a recession. So I'm saying the R word too many times maybe in this seminar, in this webinar, but this is what I believe.
No, very good. And you know, there's no doubt there, you know, clearly there's different exposures across different markets, different countries, and you know, looking at the US as a tech-heavy investment opportunity versus Europe as a more cyclical and arguably more exposed to China opportunity. There are interesting repercussions to consider that go beyond, you know, the scope of this discussion, but nonetheless. Think of farther afield a bit, some other considerations, you know, that they're, speaking of technology, you know, the whole SVB thing was about venture capital and the development of technology and the funding of that business and what have you in California and beyond. There are other innovations, disruptions that are taking place. I mean, you can't pick up a newspaper today or pull up Bloomberg or the FT, or you know, look across the swath of investment research that's coming through and not read about AI and ChatGPT. How are you thinking about innovations and disruptions, whether they be cyclical, whether they be tech trend oriented, that are impacting asset allocation decisions for you, whether it be strategically or tactically, or are you thinking opportunistic? Are you thinking risk? How do you consider this? Any one of you guys can jump in.
I may start.
Yeah.
Okay. So in my opinion, the advent of new technologies and changes in the financial landscape are redefining how banks will manage their investment portfolios. Anyway, even if I am a big fan of innovation, so this is a disclaimer, I don't believe that the investment professionals will be replaced by the AI. I think that the artificial intelligence is a tool, and because of this can support us in our job. It can help us to be more productive and take more informed decisions. But I don't think that we are going to have a robo portfolio manager in the future, because there are too many variables to control. Because it's not like playing chess. There are also irrational moves, irrational decisions taken by financial actors, and this is something that is unpredictable. And unpredictability is something that models and artificial intelligence models too don't like. And this is why I think that it's more a tool and an help instead of a threat, actually. Regarding the use in SAA and TAA, I think that it can increase the flexibility of the outputs that we can obtain. Artificial intelligence applied to asset allocation can produce also more robust output, because instead of a simple optimization, we can run an iteration and so many optimization in order to obtain a result that is the sum of many other optimizations. So this is something that it can actually improve what we are already doing, but it's not completely substituting what we are already doing. So this is my take.
Oh, fair enough. Andre?
Yeah, sure. I think this is a very interesting topic, and I think Alessandro made some very good points, especially that where we are today, AI and to more of an extent, machine learning is more of an auxiliary tool rather than something that can take on the role of providing the full service of asset management. However, I think that where machine learning today is, and the power that I have seen from a couple of the leading machine learning suppliers in the world in terms of being able to provide you as an asset manager with explainability and provide you with relevant features that you need to take into account, and also learn from those features to give you explainable signals in order to execute on in your portfolio, something that I don't think any human brain is equipped to do now. So I think from the point of curating data, processing data, and also find explainability in data and defining features that are important from time to time, given investment regimes or economic cycles that one might be in, that technology is already way ahead of what we can do as humanoids, if you like. However, at the end of the day, you still need to have an investment idea, and that is something that can't be a function of machine learning or AI today. So an investment idea is still something that is very much a function of smart people who want to execute an investment idea with a given goal, with a given strategy in the markets. But in order to also to execute it in a much more efficient and powerful way in the future, I do believe that the people or firms who will use machine learning technology and good providers of machine technology will fare quite much better than people who don't. So I concur with Alessandro, but I think one should pay attention to who uses high level and high quality data together with high quality machine learning instruments.
No, fair enough. Ismail, anything you want to layer on here?
Yes, I would say that we spend a lot of years speaking about the importance of collecting data, but what we don't know is how hard it is to process that data in order to get representative solutions that fit our investment models. Maybe we get some answers, but then it's difficult to get in our models. So here is where artificial intelligence comes in and gives us solutions to be more efficient and quick by the time we need to take investment decisions. Sometimes in the time we spend evaluating all the information, we lose some opportunities. So I see it as a good tool to implement, and I want to highlight it as Alessandro said, as a tool, not as a person or as a robot that takes the decisions for us. That being said, I also see some risk, like promoting value traps, maybe because artificial intelligence considers it as a good investment, or crowded trades that can be misunderstood by artificial intelligence. But I think that in the future, of course, we will implement it more or less, but we will take into account, and I hope that it helps us to get better returns and to give more money to our clients.
No, fair enough. I would say our asset management analyst today had published a note about, initial thoughts on AI in the asset management business, and his take was, from looking at the business of asset management as a business, it's much more of a cost control tool than it is a revenue generating tool. That everybody is always looking to do things more efficiently, and if AI can help you do it more efficiently than with fewer people, then so be it. And so, as opposed to coming up with a new trick that's going to be like I said, a revenue generating product from an industry level perspective. The other thing that does jump out to me that you all have sort of touched on a little bit in a couple of ways is the issue of crowded trades. If AI does progress and there's some interesting strategies that are promulgated because it's been successful for one and it starts to grow to others and be adopted, sort of harkens back to, I started in 1987, so I'm dating myself. But that was in the realm of portfolio insurance being such a great tool and how it was going to take away risks of the market, and all it did was to create the '87 crash. And Lord knows, hopefully AI doesn't put us back in that boat. I'm sure it won't. But the idea of everybody jumping on a bandwagon and all of a sudden finding that there's high correlation between positions can be problematic. Something we'll have to watch. One last topic, I know we're running a little long on time, that I wanted to make sure that we did touch base on, which is important. Again, harkening back to a little bit of what you all had just referenced, there's still a people element to this business. How do you deal with your clients in the time of crisis? We had SVB, we had Credit Suisse. There was a lot of concern about a banking crisis, whether it's done or whether there's still repercussions to come. What were you doing with your clients at the time, and how were you staying in touch with them? Who wants to jump in on this one?
I can start, Tim, and I think from my point of view, I think clients deal with me rather than I deal with the clients in one way. But I think that some of these events, as of lately, they are not as they are not conducive to worry and panic as we have seen previously. I think that we get more and more of these events that create quite high volatility in liquid markets. So I think people are more and more accustomed to those. I think what people are more preoccupied with is that if you would whether you would breach a certain level of volatility or risk in the from the investment guidelines or the investment policy that you have. So I think what's important here is to maintain that specified risk that you have set out together with your clients, and if you do that, I think people are very happy to live with volatility. And also you can also rely on the old adage that the volatility in some ways creates opportunity. But from my experience, the last couple of years, we have seen quite some volatile events. I mean, everything from COVID. Now we had the banking crisis, and we had a couple of one of those before COVID as well. And people are basically quite accustomed to volatility. I think it's a good thing, because prices who are in some way affected by emotions and to some extent irrationality and exuberant behavior should also be viewed as assets that can trigger some volatile events. And as long as people are fine with volatility, then you have something to manage in order to give your clients a volatility that they can live with, rather than a unintended volatility that comes as a surprise.
Fair enough. Thank you. Alessandro, Ismail?
I go. So, well, first of all, I think that when you are invested in a security that fails, the first thing you have to do is to be humble enough to recognize the wrong things made. Maybe you learn something, but and recognize that maybe we have had some better opportunities and our risk management hasn't been good enough. But that being said, as Andre said before, after facing that kind of events, there's a lot of volatility, and by volatility, I always try to explain that to my clients that there are opportunities. For me, volatility equals opportunities. So the key point is to highlight where we can construct a new portfolio, where we can find new ideas, and even if we can take advantage, if we weren't invested in that kind of assets, then to buy it at a lower price. Maybe a kind of asset that brings me in the mind is distressed debt, or that kind of assets perform well after the event triggers. So maybe if you can bear that kind of volatility in your portfolio, and if you want to take a satellite position, maybe it can add some alpha in the future.
No, very good. Now, Alessandro.
Yeah, regarding what we have done through the last volatile period, what I can add is that being transparent is always the best things to do. The best thing to do, especially in times when people get worried and driven by their emotion. We are talking about their life savings, so people should try to avoid to panic sell at the bottom of a market reaction, and being transparent, trying to explain what's going on and how the current event impacts on the long-term objective of this investment can be something that can be a lifesaver strategy in order to avoid to crystallize a loss at the bottom. And this is something that we have seen during COVID crash. This is something that somebody has experienced during the 2023 banking crisis. So this is basically something that we have to avoid. Do the wrong thing at the wrong time.
No, very good. To avoid the negative is clearly a good thing. There was one question that came up, and I think it sort of relates into what all three of you all have talked about. I think it specifically came in while Alessandro, you were speaking, but essentially it was, have you changed your exposure? And I don't know whether you feel compelled to name a name in a positive context, but the question was, is there a fund or an investment that you've recently found to help manage your exposure, your situation that maybe you weren't using before? I don't know, does this ring a bell, or do you have a thought on this, any of you all?
Actually, what we do in our portfolios is using building blocks, and the approach that we adopt is having a target volatility. So basically what we do is sticking with the geographical building blocks, both for the equity and for the fixed incomes. So we have, given that we have a long only strategy, I'm managing insurance products, and we don't include also because the regulator doesn't allow us to include commodities and these kind of things. Is what we can do is try to de-risk, but it's always hard to find something that edges completely, given that we are coming from a very difficult year, such as 2022, where everything was basically correlated, and unfortunately everything was going down. So I can't name actually something that edged me completely. What I can say is that in general, having an exposure, as I was saying, to the quality factor for the equities, in particular the US equities, helped me to navigate the bounce that we had. So this is what I can answer.
No, fair enough. Any other thoughts on this, Ismail or Andre?
No, the point I would like to make from my point of view, and I completely agree with Alessandro, and obviously Alessandro comes from a very regulated environment in terms of investments, representing an insurer. But I think one thing which is important is also to look at the overall portfolio as an industrialist. So you should view it as a company where you have a variety of silos. So you should analyze them from a point of view of term structure, payout structure, durations. And with that in mind, you should look at the opportunity set of hedges and the cost of those hedges vis-a-vis the assets that you hold on your book, and put them into a context, whether this is a long-term reassessment of your asset price or is this a short-term volatility. And if it's either one of those, you should do a very fair cost-benefit analysis of the outcome of those hedges, and whether they would serve you right at the end of the day, or just do nothing besides incurring a cost on your portfolio.
No, fair enough. Ismail, any last thoughts on this?
Well, I would say that if I had to choose one kind of funds that should have performed well in that kind of events, would be tail risk funds. But we know that we don't own the crystal ball, as I said in my first answer. So yeah, it's very difficult to hold it in a long time, because we know how it works. It only performs well when a great event triggers. So it's hard for the common clients to hold it in a long time in the portfolio. So if you were lucky enough to hold it during March, I congratulate you, because for sure it has been a good choice. But in the long time, it's quite difficult.
No, fair enough. Well, look, we've carried on now for approaching 50 minutes. We've covered a lot of ground. There are a few things, we could still, dive into, but maybe best to bring the conversation to a close at this point. Really appreciate the thoughts, the insights, the perspectives. Appreciate the questions from the listeners, and I'm sure that any and all of us would be more than happy to follow up with thoughts, connections, and whatnot, whether it be through LinkedIn or across Bloomberg or whatever else. So we'll, like I said, bring things to a close here. I really appreciate everybody's time and attention, and we'll bring this one to a close. Thank you for your time.
Thank you.
Thank you.
Thank you.
Thank you.